If you're looking to get a fix and flip done, but you're short of the down payment, closing costs, or even getting those contractors started before the first draw, we're going deep on gap funding requirements and the private version versus the institutional capital stack version, otherwise known as data lending on the private side, what it actually takes to qualify for both. Let's get fair up it. So, overview, the gap between expectation and reality. If you're searching gap funding requirements, you're probably picturing something simple. Decent credit, good deal, done. The actual published requirements from one of the bigger private gap funding pages is nowhere close to that. This breakdown walks through their real terms and puts them side by side against 3 tools that require none of it. So let's go. Now, the concept, what gap funding is supposed to solve. Here's the promise. Gap funding covers the shortfall between your primary loan, your hard money or your DSCR, and the total project cost. The down payment, the renovation budget, whatever's left over. Now, the reality is it's a simple concept. The requirements are where it gets complicated quickly. That what sounds like a straightforward bridge tool comes loaded with conditions most investors don't see coming and don't have the timeline for 3 days out from closing. So covers down payments and renovation costs, bridges the gap to total project costs. Sounds simple in theory. The requirements are not. So let's look closely at them. Requirement 1, the amount is capped small. Before anything else, the actual numbers tell the story. This isn't built to solve a large capital gap. It's capped at a fairly modest one from the start. 50K max gap funding, that's not a very big project. And it's the ceiling on how much gap capital you can actually receive through a private investor. 150K max renovation budget, the maximum rehab budget this product even applies to. This isn't built for large capital gaps, only a modest one. If you're doing larger deals, you're stuck with private here. If you're doing a multi-family, then we're talking about syndication or private investors, limited partners. So that's a different concept altogether. Requirement 2, you need a track record. This one surprises people. You need at least 3 completed deals with similar rehab budgets to qualify for their standard terms. Their own page says this product is best for experienced investors specifically. Why is that? Because they're underwriting you as the operator. Good operator's not going to do a shit deal. Before they even look at those numbers, they're going to check out what's your track record. So standard terms is require 3+ completed deals. Newer investors, not excluded outright, but you receive adjusted, less favorable terms to offset the perceived risk. In their own words, the product is explicitly described as best for experienced investors. Experience isn't a bonus. It's actually a baseline. Requirement 3, you have to not need it. Here's a big one. Their own stated positioning. This is for investors who could close on their own, but want to preserve capital strategically, not for people who genuinely cannot close without it, which is no good because it's expensive capital. So why would you? Read that again. If you actually need the money, you're not who this is built for. The people who most need this capital are who it's explicitly not designed to serve. So understanding that it's not for anyone who genuinely cannot close without this capital, which is exactly who searches this term. So a bit redundant. Requirement 4, you get personally vetted. 4th, you go through a borrower interview and submit a personal bio as part of qualifying. This is like your resume of the deals you've done over the past couple of years. The capital source has to be personally comfortable with you before anything moves forward. This isn't a set of standard underwriting procedures. This is an individual you're having to convince to go second possession on your deal. A bit of a tall order with their hard-earned savings. So the borrower interview, personal bio required, judgment call, isn't standardized underwriting. It's a personal decision about whether they're comfortable with you specifically. The real cost, all of it stacked, all of it paid by you. The fee structure on gap funding isn't a single charge. It's a layered stack that compounds quickly. So double origination on your primary loan, then second origination charge on the gap funding itself. 15% return on a max 6-month timeline is 30% ARV. There's a connector fee. That's the one running around connecting you with these private investors on the Facebook groups. They're taking a 2 to 5% chunk, and then a coordinator fee who's underwriting it, roughly $1,000 in transaction to be conservative. Now, requirement 6, the timeline and the lock-in. Closing timeline, 3 to 4 weeks is extremely conservative. We're talking more like 2 months here. Slower than standard loan and far from the fast-moving capital the name implies. Term length, the term runs 6 months, extendable to 9 on a case-by-case basis. Not exactly the fast in and out you'd expect from something called a gap fund. The bundle trap. You cannot shop this separately. Gap funding is typically only available bundled with a hard money lender's own first position. The only reason they're willing to take that risk is because they're making a double commission. Now, all of this said shows you that this product doesn't really exist. It's an extremely rare use case where maybe if you can convince the hard money lender and the gap lender to all come together and agree on terms, and none of that is reliable. So alternative number one, here's where we need to prick up the ears and listen closely. A term loan instead. Put gap funding's requirements against an unsecured term loan, and the contrast is immediate. No completed deals required, no requirement that you already be able to close without the money. That's the entire point of using it. No experience requirement, no, you don't need it clause, funds in 1 to 3 days, no personal interview standing between you and an answer, fast, direct, and standardized, cash in the bank, ready to go. And you know it's locked in, so you can walk into the deal with confidence. Alternative two, 0% credit card stacking. This is a big one. Instead of 15% or higher return owed to a private capital source over 6 months, you get an actual 0% rate for 12 to 21 months. The fee structure disappears entirely. So that's 0% for 12 to 21 months. No stacked fees, no track record needed. And the beautiful thing about this is it can be stacked after the term loans as well. So you can go wham, bam, thank you, ma'am, and get ready within a 10 days total. A HELOC for business use. This is a really interesting product out now by digital lenders. A HELOC against a property you already own offers a compelling third path with access that dwarfs gap funding ceiling and rates that aren't in the same conversation. So this can be done on a home or even an LLC-owned investment property as well. If you've got equity sitting anywhere, we're talking a 6.8% starting APR. It's tied to the prime. It's going to be 1% more expensive on an LLC as opposed to a home. You've got a $750K borrowing limit. So for larger projects, this is great. And 5 days to fund, funding in as few as 5 days, no personal interview, no experience requirement. These days, they're underwriting it digitally without sending a bloke out to evaluate your property's equity either. So comparison side by side, lined up, it's not even close. Your private gap or gator lending maxes out at 50K, 3+ completed deals over the past year or two, 15% plus stack fees, 1 to 2 months, personal interview required. And if we compare that to the other things, we can actually stack all on top of each other. That's term loans, 0% cards, HELOC, each of them funding in under 5 days. This is a massive spread and a difference that institutional capital is actually providing us here. We've got no other chiefs in the tribe. We make our own decisions without someone telling us how we're entering, when we're exiting, etc. And why this comparison makes gap funding look absurd. Every single requirement that makes gap funding hard to actually get, the experience threshold, the personal interview, you have to not need it clause, none of the alternatives ask for any of it. Same underlying need, radically different bar, a completely different standard. The alternatives don't just cost less, they remove every structural barrier that private gap funding erects in front of the capital, including the uncertainty of that private lender's financial situation changing last minute, pulling out 3 days before close. We see people coming in distraught, stressed out of their brain all the time with 3 days before closing because the private gator pulled out. Now, reality check, who gap funding is actually built for. The narrow slice it serves, gap funding, private gap funding that is, as actually written, is built for a narrow slice of investors, people with 3 or more deals behind them who technically don't even need the money and want to preserve their cash strategically. And it leaves out everyone on their first or second flip. It's not built for someone genuinely short on capital, and which is exactly who's typing this question into Google. The irony, the investors most likely to search gap funding requirements are the ones this product was explicitly not designed to help. The term sounds inclusive, the actual terms are not. So how do we help with this? This is our approach. This is exactly what we help investors work through, looking at your actual capital gap, your actual credit file, then matching you to whichever of these tools genuinely fits. We review your actual file, match you to the right tool. We identify which option, term loan stacking, 0% card stacking, HELOC, or even business lines of credit genuinely fit your situation, and straight talk, no upsell. We'll tell you straight when a tool doesn't fit instead of selling you one. No track record required to start the conversation. So if you're ready to find the capital that actually fits your situation, if you search gap funding requirements because you're short on capital for a deal, book a call. We'll show you real options fast. To be totally clear and upfront, you're going to want to at least be at a 650 credit score, making 50K a year. And these are tools that fund in days, not weeks, and honest matching. We'll tell you what fits and what doesn't. So head over to gapfunded.com/apply. Link in the description below. Pretty straightforward there. I'm talking days, not weeks. My name's Mick Wadley, founder of GapFunded. Private gap funding requirements are a lot narrower than the term makes them sound. Built for investors who barely need the help. If this helped clarify the landscape, there's more breaking down of each of these alternative tools on their own: term loans, credit cards, HELOCs. Head over to gapfunded.com/apply. Let's go close something. If you love this video, if you absolutely adored it, head down, smack the subscribe and flog the bell, and I'll see you on the next one.